Welcome back to our journey through the market matrix. In our previous videos, we've explored how markets function as a psychological game, how patterns reveal mass emotion, and how proper risk management depends on understanding your own mind. Today, we're zooming out to examine the larger psychological cycles that drive market movements over time. Market cycles aren't random. They follow predictable psychological patterns that have repeated throughout history across different assets, countries, and time periods. Understanding these cycles gives you a powerful framework for positioning yourself ahead of the crowd. At its core, a market cycle is simply the emotional journey of the collective market mind, from fear to greed and back again. While financial media often attributes market movements to economic data, earnings, or news events, these are merely the catalysts that trigger underlying psychological shifts that were already primed to occur. The classic market cycle consists of four main psychological phases: accumulation, markup, distribution, and decline. Let's explore the psychology driving each phase and how to recognize where we are in the cycle. The accumulation phase begins after a prolonged decline when general sentiment is negative. Most participants have given up, media coverage is pessimistic, and trading volume is low. Psychologically, this phase is characterized by disbelief, apathy, and depression. The prevailing narrative is that things will never improve. This is precisely when smart money begins accumulating positions. They recognize that negative sentiment has pushed prices below fundamental value. While the general public focuses on recent pain, these investors focus on future opportunity. How do you identify this phase? Look for price stabilization after a significant decline, declining volatility, decreasing correlation between quality and lower quality assets, and contrarian statements from experienced investors being met with ridicule. Sentiment indicators like put, call, ratios, consumer confidence, and surveys of market participants will show extreme pessimism. The markup phase begins as more participants recognize the improving conditions. Psychologically, this phase transitions from hope to optimism to belief. Early in this phase, gains are met with skepticism. It's just a bear market rally. As prices continue higher, the narrative shifts to cautious optimism. In the middle stage of markup, institutional money joins in, driving stronger momentum. Media coverage becomes more positive, and previously bearish analysts begin revising their outlooks. The late stage of markup is characterized by increasing public participation, rising trading volumes, and growing optimism. How do you identify this phase? Look for higher highs and higher lows in price, expanding volume on up moves, positive breadth with many stocks participating in the advance, and sentiment shifting from cautious to increasingly optimistic. The narrative changes from things are stabilizing to things are improving to things are great. The distribution phase occurs as smart money begins to exit while maintaining the appearance of strength. Psychologically, this phase is characterized by euphoria, complacency, and overconfidence. The prevailing narrative becomes, "This time is different," as participants justify historically extended valuations. During distribution, market leadership narrows, with fewer stocks driving index gains. Speculative activity increases in low-quality assets. Despite weakening internals, headline numbers remain strong enough to maintain the bullish narrative. This creates the illusion of health while the foundation is actually crumbling. How do you identify this phase? Look for deteriorating market breadth, increasing divergence between price and fundamental measures, growing speculative froth in lower quality assets, extreme bullish sentiment readings, and the proliferation of new era thinking that justifies abandoning traditional valuation metrics. The decline phase begins as selling pressure overwhelms buying interest. Early in this phase, declines are seen as healthy corrections or buying opportunities. As prices continue lower, psychology shifts from concern to fear to panic. Media coverage becomes increasingly negative, focusing on the worst possible outcomes. During decline, correlations between assets increase as participants sell indiscriminately. Quality is abandoned alongside speculation in the rush for liquidity. Volume expands on down moves and diminishes on rebounds. The prevailing narrative shifts from temporary setback to systemic problems to everything is broken. How do you identify this phase? Look for lower highs and lower lows in price, expanding volume on down moves, deteriorating breadth with most stocks participating in the decline, and sentiment shifting from concern to outright fear. The narrative changes from buying opportunity to fundamental problems to avoid at all costs. Understanding these psychological phases gives you a powerful framework for positioning, but there's an important caveat. These cycles don't unfold according to a predetermined timeline. They can extend or contract based on external factors and policy responses. The key is recognizing the psychological signs rather than trying to time exact tops and bottoms. Now, let's discuss how to apply this understanding practically. In the accumulation phase, focus on quality assets that have been indiscriminately sold. Look for companies with strong balance sheets, competitive advantages, and the ability to survive extended weakness. This is the time to gradually build positions while maintaining patience. Psychologically, this requires the courage to buy when others are fearful and the discipline to average in slowly rather than trying to catch the exact bottom. In the markup phase, consider adding to winners and expanding into higher beta assets that benefit from improving conditions. This is the time to let winners run while maintaining appropriate position sizing. Psychologically, this requires overcoming the urge to take profits too quickly out of fear the gains will reverse. In the distribution phase, begin reducing exposure, particularly to speculative positions, raise cash levels, and shift toward defensive assets. This is the time to focus on capital preservation rather than chasing diminishing returns. Psychologically, this requires the discipline to step away while the party is still going and to withstand the social pressure to remain fully invested. In the decline phase, focus on capital preservation through hedges, cash positions, and select countercyclical assets. For skilled traders, this can also present short selling opportunities. Psychologically, this requires emotional control to stick to your risk management plan when others are panicking. It's worth noting that different asset classes and sectors may be in different phases simultaneously. Technology might be in distribution while commodities are in accumulation. This creates opportunities for rotation rather than simply going all in or all out of the market. Additionally, cycles exist within cycles. A daily chart might show decline, while the weekly chart shows a larger markup phase. Understanding these nested timeframes helps prevent overreacting to shorter-term movements that oppose the larger trend. Let me share a perspective on how I view market cycles. I see them as the collective emotional journey of market participants. Prices don't just reflect current fundamentals. They reflect expectations, emotions, and narratives about the future. By understanding where we are in this emotional journey, we can position ourselves to profit from the predictable behavior of others. For example, during accumulation phases, I focus on identifying quality assets that have been oversold due to emotional rather than fundamental factors. I look for signs of smart money accumulation, stabilizing prices on declining volume, divergent strength in industry leaders, and insider buying. These signals often appear while headlines remain negative, creating the opportunity gap. During distribution phases, I pay close attention to market breadth, speculative activity, and narrative shifts. When I see narrow leadership, increasing speculation in low-quality assets, and arguments for why traditional valuation metrics no longer apply, I know it's time to become increasingly defensive. The psychological advantage comes from recognizing that most participants are driven by recent experience rather than historical patterns. After extended bullish phases, most investors can't imagine a significant decline. After extended bearish phases, most can't imagine a sustainable recovery. This recency bias creates the very opportunities we seek to exploit. To develop your own market cycle awareness, I recommend several practices. First, study market history. Previous cycles provide the template for understanding current ones. While the specific catalysts change, the psychological patterns remain remarkably consistent. Second, follow measures of market sentiment and positioning. These include surveys of investors and consumers, put-call ratios, fund flows, and positioning data from the Commitment of Traders report. These indicators often reach extremes before market turning points. Third, pay attention to the shifting narratives in financial media and among market participants. When justifications for current conditions become increasingly extreme or detached from historical norms, it often signals a phase transition is approaching. Fourth, develop a consistent framework for evaluating where we are in the cycle and review it regularly. This prevents getting caught up in day-to-day movements and helps maintain strategic clarity. Fifth, remember that cycles don't follow a predetermined timeline. Focus on psychological and behavioral signs rather than trying to time exact tops and bottoms. In our next video, we'll explore the concept of contrarian investing, how to develop the psychological strength to go against the crowd, and how to distinguish between legitimate contrarian opportunities and value traps. Until then, remember that in the market game, understanding the cyclical nature of mass psychology is one of your greatest advantages. By positioning yourself for the next phase rather than the current one, you can capitalize on the predictable emotional journey that markets have followed throughout history and will continue to follow as long as humans remain human. Before we wrap up, I want to invite you to join our trading community where we put these psychological insights into practice every day. In our Discord, we provide AI-enhanced trading data that helps identify these market cycle phases with greater precision. We've consolidated the most valuable trading resources so you don't have to waste time searching across dozens of sources. Whether you're looking to discuss cycle positioning with like-minded traders, access our curated educational resources, or benefit from our real-time market psychology updates, I encourage you to join us. The link is in the description below. Remember, understanding market psychology is powerful, but being part of a community that reinforces these principles makes implementation much easier. Join us today and position yourself to capitalize on the psychological patterns that most traders miss. I look forward to seeing you there.